Last time, I looked at these conceptual models to show the effect on an equity curve as leverage is increased by a trader. I illustrated how the equity shows exponential growth initially, but then as leverage increases further, this growth suffers major setbacks as it gets broken up by periods of excessive drawdown. And it doesn't matter how good your strategy's edge is. If you increase leverage too much, this is the effect. And it's purely down to mathematics. There's a linear relationship between drawdown and leverage. In this episode, I back up these models with actual trading data on the Darwinex platform. Back after this brief message. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. If you're a talented trader looking to attract investor capital to your strategies, Darwinex is the fastest way for you to do this. We enable traders to raise third-party investor capital and then charge success fees on high watermark profits. Additionally, Darwinex itself invests in its traders with our seed capital allocation program that allocates up to 90 million euros per year in successful trading strategies. So, if all of that sounds interesting, learn more by clicking on the link here, or you can find further links in the description right below. Now back to today's tutorial. Let's move on from conceptual models to actual live trading data from a trading strategy hosted on the Darwinex platform. The Darwin that I have chosen to look at is one that is currently showing a profit, and over the last 5.5 years, this is now at a return level of 68%. However, there have been some fairly severe drawdowns on the way, and the drawdowns were so severe that it still isn't making new highs above the levels achieved 2 years ago. But remember, when we look at the return risk tab here, we're looking at a risk-adjusted Darwin. So this is the investable asset that investors can buy, and those returns have been risk-adjusted by the Darwinex risk engine to a risk level of 6.5% value at risk, or VAR. But by choosing the underlying strategy tab, here we can look at the raw strategy of the trader's account itself. And if we just select all here to look at the entire time frame, this is what the curve looks like. So the first thing that you notice is that here the drawdowns are even more severe than on the risk-adjusted Darwin. But for now, let's just go back and look at the most recent year of data, because there's been a significant change in behaviour of the trader during this time. So in the top section here, obviously we have the equity curve itself. And underneath that, we have a measure of what's called D-leverage. And this is a proprietary measure of leverage used by Darwinex. And this gives a really good indication of the risk that this strategy has been working under based on the original leverage used by the user, but also the volatility of the positions opened by this trader, and also paying attention to correlation of those positions. So for example, if two independent positions were opened using two assets that were highly correlated, then that would actually add to the risk. And so all these factors are taken into account. Now, early on in the year here, the level of deleverage is fairly high. And take a look at what is happening to the equity curve. It appears to be very erratic. So at this point, we've gone from a profit of 20% down to a loss of 20%. And that's happened a couple of times. And this kind of erratic behavior is what we get with high leverage. But then the leverage begins to decrease. And with that, the overall equity here becomes a little bit smoother. So let's focus on this section here, between this point and this point. So leverage is first of all much less than previously, but also it's greater than what the trader was trading after this point. So let's think of this as a middle ground and look at the equity curve. You can see the drawdowns here are not as severe as they were at the beginning of the chart, but are more severe than they are in the later part of the chart. And so again, this just illustrates the direct relationship between the amount of leverage and the drawdowns. And then for the latter half here, the trader's taking much less leverage, and look how smooth the equity curve has become. Now, the first thing that might cross your mind is that, well, yes, the equity curve is smoother, but the trader isn't making very much profit. But let me just remind you of the previous episode when I talked about investor leverage. What's happening during this period of stable returns under low leverage is that the Darwinex risk engine is kicking in and risk adjusting this to a 6.5% VAR. And so the effect on the Darwin is that actually we see fairly nice growth here. And this, remember, is what the investors will be receiving. And so, although the trader's own equity curve isn't moving very steeply, the potential to make money from investors is greatly increased. And because we have much smaller drawdowns here, which of course investors like, a strategy is more likely to retain those investors under these conditions. Now, just for confirmation of this behaviour, we can turn to one of the investable attributes, and this is the risk stability attribute. So this just confirms what I've been talking about. As you can see here, in March 21, the trader was operating their own account with a monthly VAR of about 34%. So during this time, the risk engine that sits behind the Darwinex platform would have been risk adjusting this strategy down to 6.5%. However, over time, as the trader has reduced their leverage and their position sizes, the VAR has reduced so that now this trader is operating at a 2.9% VAR. So the risk engine here is actually doing the opposite. It's risk adjusting this strategy upwards towards 6.5%. And that is why, even though the raw strategy equity was only climbing slowly, when we look at the Darwin, we see this rise much more quickly. And it's the risk engine that's enabling this growth. Now, if we return to the underlying strategy for a moment, and now we look at all of the history, we can get an idea of the extent of these drawdowns. At this point here, the trader was sitting on approximately somewhere between 200 and 250% return. But then a relatively short time after this, and you can see that the account equity has fallen and just goes below the zero level. And as the system was suffering this drawdown and coming down here, you'll notice that the trader doesn't reduce their leverage. They don't necessarily increase the number of positions, but it's that ratio of the positions to the equity in the account, and the equity of course is falling, that means the deleverage is increasing. And this is what's putting undue risk on the account, and eventually the trader loses all of the gains they'd previously made. So I hope that's a good illustration of the dangers of over-leveraging. What we have in this strategy is what looks like a really good edge. For the majority of the time, the strategy is making money. But unfortunately, because of over-leveraging, it's led to this rather erratic equity curve. Now, in the next episode, I'm going to look at this subject from a slightly different angle. And here, I'm going to look at one of my own trading strategies. And this is a strategy that served me well over the last 5 years, has a steadily increasing number of investors, but I'm going to run that strategy through a number of different scenarios, all based around different levels of leverage, so that we can look at what happens to the system under those different leverage conditions. So be sure to tune into that. If the episode's already available, then you'll see it top right now. Also, if you want to find out more about Darwinex and the services that we provide, there's a link right underneath. But until then, keep an eye on that leverage and trade safe.